Hello, Brittany and Marie here. Welcome to the Property Management Show. Today we will be interviewing Jeff Hacker from Bayside Property Management, all the way in Marin County, California.
He will be talking to us about industry trends, in the primary, secondary, and tertiary markets. So if you're someone who wants to learn more about rental market trends in your area, or know how to keep up with the ever-changing trends in the industry, make sure you keep listening. This episode is sponsored by PM Growth Summit. It is the annual conference for growth-minded property managers. Our 2020 conference is brought to you by 4&Half Property Management Marketing Agency in partnership with Seacoast Commerce Bank, the preferred bank for property management trust accounts. The next PM Growth Summit will be in Austin, Texas from May 27 to 29, 2020. Go to pmgrowthsummit.com to register.
Jeff, thank you for joining us today. We are excited to have you on the podcast. Before we get started talking about the topic, we were hoping, per usual, that you just give us a little bit of information about yourself, background, just like fun facts, tidbits about who you are.
Happy to do so, and thank you for having me here. So I'm Jeff Hacker. I'm the owner and broker of Bayside Property Management. Bayside has been a property management company in the Bay Area for about 30 plus years now. However, I've only been at the helm of it for about the past 15 years.
Only
the past 15 years. So prior to that, though, I worked for a major corporation, working with them in expanding their retail presence, not only throughout the Bay Area, but pretty much throughout, California and the Western United States. So that's where I'm coming from. And then from time to time, I work with a handful of small investors who unfortunately now have been primarily priced out of the Bay Area market, but are always looking to me for advice as to other markets that they can invest in as far as, purchasing real estate, either small single-family homes, small duplexes, fourplexes, or even somewhat larger, multi-unit apartment complexes.
That's cool. So even if they don't have the budget to invest in the Bay Area, you'll still consult them on kind of properties to buy and where.
Right, because a lot of these people are clients, and so it's a way to maintain, the client relationship and stay in good standings with them.
Yeah. And so, that's a great segue to our topic today. So when you first started talking about possibly inviting you to become a guest at our podcast, which finally happened.
Yay.
We were interested in talking to you about primary, secondary, and tertiary markets, and sort of like what are the trends now. But before we dig into those trends, can you give our audience an idea of how you define those different levels of markets? Because different people define them differently. And so, rental property management expert, I want to hear from you.
Yes.
Okay. Well, I'll do my best. As far as, the different tiers that you have, typically it's broken out into 3 tiers. You have your primary markets, or sometimes referred to as gateway markets. You have your secondary markets, and then you have your tertiary markets. Most people define those purely on population, which isn't probably the best way to do it, but typically if you go out there and you look and you do any type of search, you'll see it mostly split out on population, whereas like the primary markets are probably defined as 5 to 6 million plus. Your secondary markets anywhere from about 1 million to 5 to 6 million, and then tertiary markets are generally defined as less than 1 to 2 million and less is how tertiary markets. But when you're really looking at it from an investment point of view and what it holds from a rental point of view as well, there's a lot more that has to go into that than just population. You need to take a look at, what's the access to major airport, for example. What's the job growth look like? What does the GDP, look like? Is there a major university? Is there even a major sports team, for example? Those are all things that you really need to take a look at when you're evaluating, the different markets out there and as far as the potential for investment opportunities. And then you also should look at, like the flow of capital in and out, both domestic and foreign. You should take a look at, what type of real estate transactions have happened, over the last handful of years, both in total volume as far as number of transactions and then sales dollars, and then, what's going on with the cap rates. Are the cap rates remaining steady? Are you starting to see pressure on cap rates and they're starting to drop? That all plays into, how you define and look at, each of those markets from an investment point of view.
So if you were looking to invest or consulting somebody on investing in a property, would you say that you wouldn't, like just to kind of reiterate or re-ask what you said, you wouldn't necessarily start by the population, or would you start there and then look at the other factors after that?
I don't necessarily look at population. I look at most of those other factors first, right? Because I think they have they're a much stronger indicator of what to expect from an investment point of view other than just population. I mean, you could take a look at a small market like Bakersfield, for example, and you wouldn't think that Bakersfield would be that good of an investment. But then if you start looking at some of the underlying market indicators in Bakersfield, you'll realize that, Bakersfield is actually a pretty good spot to, invest money right now for real estate.
That's a really good example. And we were talking to Eric Hoagland
from
sorry,
ST.
Eric. We're talking from ST Real Estate a few weeks ago, and he had brought up Reno as like a good example to that too. Like they just have Tesla there, which I don't know if prior to that happening, Reno was a good place to look at for investments because they do have obviously UNR's there. Like maybe tourism, I don't know, but that's obviously a big plus.
Yeah, Reno has actually been a pretty good market to invest in for a while, only primarily because of, the Nevada tax base, right? So you're starting to see a lot of people move out of California where the tax base is quite a bit higher and then moving into a much lower tax base, such as, Reno and, even parts of like, Las Vegas, for example, or Henderson is another good example. Mm-hmm. So, the state and the tax base has a, huge role in playing into that as well.
And so, given that you have been working with different types of investors throughout the years, your short 15-year, stint in property management. So what are the major changes that you have observed? If you want to tell us, based on the tiers or just the broad perspective, like just give us an idea of how it looked like when you first started venturing into this industry and how it looks like now.
Okay, yeah, I can do that. So I think the best way to probably tackle that is to sort of look at it sort of from a broad perspective first, looking at maybe your different population demographics and sort of what's transpired there before diving into each of the different markets. So from a broad perspective, about 15 years ago, the number of college-educated renters was, pretty small. There's a lot of, non-college educated, people, the college educated tend to be home buyers and stuff like that. But then, with the recession that hit in 2008, 2009, 2010, right, you saw a real shift about that time in change of home ownership. And you've had a lot of people sort of become disillusioned with home ownership. So you're starting to see, one of the fastest growing segments that you have in renters is actually the college educated. Yeah. So, you're seeing a lot more college educated renters out there, and they tend to be, it's not just that they're going to the urban environments, but they're also, hitting the suburban environments, hard as well. They're looking for the single family homes is what they're doing, quiet, safer, family friendly neighborhoods is where they're looking to do that. About 15 years ago, 10 years ago, single-family homes made up maybe about 30% of the market, and they're now probably up to about 35% of the market as far as rental units go. And that's largely because, during the recession, you had all these big institutional buyers come in and snap up all these underwater homes, so to speak, and keep them in their portfolio. Is what's happened. So, but from the demographics, I mean, you have the four general demographic groups. You have your Gen Zs, which are born in 1997 or younger, like probably you folks, and then you have you have the millennials, born from about 1980, 81 to about 90, 96. Okay, and then you have the Gen Xers, right, who were born from like 65 to about 1980, 81, and then you have the baby boomers, all that were born prior to 1965. Hey, that's me. Yeah, really. So as far as each of those segments go, the baby boomers are the fastest growing market segment you have as far as renters go. They're starting to downsize. They're giving up their homes. They're moving mostly into urban areas where they're looking for that walkability, right? They want the amenities. They're looking for access to healthcare. They're looking for access to theaters, restaurants, shopping, outdoor spaces, but they just don't want the hassle of home ownership.
They don't want to deal with the upkeep.
Exactly. They want to simplify their lives a little bit is what they're doing. And at the same token, you're also starting to see them move into the suburban areas a little bit more into the planned communities. Like sort of the retirement communities, you're starting to see, so that happen as well. So, so you have kind of it going from, the core family sort of suburban to sort of, the suburban area where it's planned communities and or the urban areas is where you're seeing that. And then you're seeing the Gen Xers, that's probably the next fastest growing segment as far as the demographics going. That they're growing about 14%, and they're primarily moving to the suburbs is where they're looking. So, you're seeing a big push towards the suburbs again. The millennials and Gen Zs, they're the slowest growing markets right now, but the Gen Z, that's expected to grow quite rapidly over the next decade or so. Right now, there's estimated to be 5 to 8 million of them in the marketplace, and that's expected to grow to be about 55 to 60 million over the next 10 years as they start, graduating from college, getting out on their own, looking for places to live, as they settle into their jobs. So that'll be a big area of growth, coming up. As far as, sort of expectations, the Gen Zs, millennials, Gen Zs in particular, as we all know, that they've grown up with technology, so they're used to technology, and that's what they want, right? To them, that's what drives everything in a lot of respects, so they're looking for the online payments, they're looking for free Wi-Fi and docking stations, right? That's what they want. They also are looking for, credit reporting. So where, if they're paying rent, they want that to go towards their credit report so that they actually have an opportunity to build credit. Because the likelihood of them being able to purchase a home anytime soon is pretty small, so they need the opportunity to build credit. And so, they're looking for things like that. So, but they're also a much more casual group, right? They're more laid back, more casual. They're looking for equality. They want the simple messaging. Electronic communications is what they want. They want to be able to report things electronically. They want, they're looking for people to be responsive electronically. Those types of things. So that's what, the Gen Z and largely even some of the millennials are, in that same boat.
What are some challenges that you're seeing just from the way that the market has changed and continues to change?
Yeah, the challenges are pretty significant. I mean, you've got quite a few of them out there. You really do. I would say that probably the three biggest ones are tenant retention, portfolio loss, and then, the big one is affordability is what you have. As far as, tenant retention goes, you're starting to see sort of a slowdown in the marketplace. You can expect occupancy rates to fall, right? And so therefore it's going to become critical to try to retain tenants as much as possible. Largely, over the last decade or so, I would say that, in the multi-unit housing situation, that occupancy rates probably hovered somewhere between 50 and 60%. Right, and so because you generally have large turnovers in the multifamily units is what you have, and that's probably expected to fall over the next few years to maybe as low as even 40%. So tenant retention is going to become critical, and as far as tenant retention goes, the key there is just making sure that you're meeting their needs in an empathetic and responsive manner, right? Yeah. So that's critical there. Because they want to know that they've been heard, that their needs have been taken into consideration and that you're trying to respond to their needs and various things like that. So, tenant retention is going to become a big issue there. Related to that is, job growth, and it almost seems counterintuitive, but, the higher the job growth you have, the less retention you have because people want to move closer to where their jobs are. And so as they're shifting jobs, they're also shifting housing to be closer to where they live. Right, so you've got that factor playing into it. So in markets like the Bay Area where you have significant job growth, you see quite a bit of movement at times. The other area that you have is portfolio loss, right? And what's going on there is in the big markets, the primary markets, gateway markets, you see mostly the big institutional investors, big money, deep pocket people coming in, buying up not just single family homes, but the larger apartment buildings. And a lot of those companies actually self-manage. They already have their management staff, there, they self-manage. And so, some of these buildings sell, and the big deep pocket people buy them, the people that were managing them before, are out of luck, and they get self-managed, so you have portfolio loss there. Or what we're seeing now in parts of the Bay Area is you're having a lot of people sell their single family homes and taking their money elsewhere and putting it into other smaller markets where you may have a higher yield.
Like in California?
Especially in California, yeah. Well, a lot of if you're selling in California right now, mostly they're moving it out just because of the latest, statewide rent control measure that was just signed into law. So that that's hurt. So you have that, and then the other part of portfolio loss too is actually the advent of technology. And so since you've had this real boon in technology, especially as it pertains to property management. A lot of the accidental landlords, are finding it easier to manage, their properties, and that they can do so fairly efficiently without the headaches that they've had in the past, by deploying technology. And so as a result of that, they're actually looking at these as like small businesses now, right? And so, you buy a handful of properties, 10, 12, 15 properties, and you can make a small business out of it and live pretty comfortably and not have the headaches that, you've had in the past just because of technology. So, you're starting to see portfolio loss, from that point of view. And then the big one is obviously the affordability. I mean, it's one of the reasons why you're seeing such a big increase in the number of renters is that, home ownership has dropped, significantly, and the affordability of that has dropped. And so, for many people, renting, even though you have high rents here in the Bay Area, that's still more affordable to them, than buying a home, right? And you're having, especially in the major markets like, San Francisco, Chicago, Boston, New York, Los Angeles, a lot of tenants are paying up to close to 30% of their income or more, towards rent. And so, that becomes a real affordability thing for them, and especially for the millennials and Gen Zs, who are also straddled with a lot of student debt. So, that becomes a big issue, a really big issue. And, as a property management, company, one of our tenant screening criteria is, can you afford this? So how much are you paying in rent versus how much you have in income, and then what other kind of debt you have, right? And so it becomes, a screening issue, and it's like, you have all these things over here, and it's like, this would be the perfect tenant, but this is all they make, and this is how much rent is, and you're at 35% of their income, and it's
and
like,
they owe $200,000 in student debt.
right. So it's like, do you take a chance on them? Do you go with them, or do you stay with your screening criteria and say, it's not going to work? Those kinds of things. And so as a result of that, I think one of the things that you're seeing, especially in more urban areas, is you're seeing a lot of subletting of rooms.
Yeah.
Right. You'll see like somebody rent a 2-bedroom apartment, and you'll have 3 people living in a 2-bedroom apartment, and you'll have one couple or 2 people sharing a room, all in a way to just kind of reduce the rents.
Yeah. How do you think that the work from home culture has any impact on the market trends? Like, for example, if you work for a company in San Francisco, but you don't need to go to work every day, you just have to go in one day a month or one day a week, do you think that encourages residents or renters to live even further out if they're not having to commute there every day, which could that impact the not opportunity, but just the benefits of investing in places further out, as an example?
Yes. Yeah, definitely. I think that's a huge thing that certainly is driving some of the changes that you're seeing, is the more work from home type of thing, where people can actually work and live in an area that they want to be in, and then not have to deal with the long commutes associated with that. So I mean, you see that in Livermore a lot, or Pleasanton, Walnut Creek. You see a lot of people living and working out there, but yet their main office is San Francisco or San Jose. but yet they only go in maybe once or twice a month, type of thing. So yeah, so that's definitely driving it. And what's nice about that too is that also helps with the customer or tenant retention, right? They tend to be a longer, more stable tenant because they don't have to move to follow their job as much.
That makes a lot of sense. Because I feel like obviously we're seeing that in our company even, because a lot of us, we have a few web developers that don't really ever come to the office just because they live close enough to where they can come if they need to, but also far enough away that it's a pain to come in every day. And if they lived closer, it would be significantly more expensive.
Yeah.
Yeah, and that's, you can thank technology for that, both from, as we were talking earlier about the stability of the internet, 10 years ago, 15 years ago, you would have, at times, a lot of internet outages, but, over the years, that has stabilized tremendously to where, you don't see as many outages as you have before. And then, technology then and, software has obviously kept up with that to where you have a lot of the cloud computing software out there now to where, people can work very efficiently, share documents and all that kind of stuff. You've got the video conferencing that you can do, so people can stay in touch without necessarily being, right next to each other, sharing cubicles or being in the same office. And that's true with property management as well. It's like a lot of these property management software companies out there, Buildium, Yardi, AppFolio, PropertyWare, they all have their cloud-based, platforms now to where you can work remotely, right? You can do, your inspections online, you can have shared documents online, you have, the e-signing online and all that, applications online, payment online, financials and, resident portals, and owner portals, so all that stuff can now be done remotely. So, you don't have to have that presence in the office all the time.
You don't have a filing cabinet you have to go digging through.
Exactly.
Extra
space. Just a lot of electronic files that you now have to go through.
What are these files you speak of? We don't like paper.
Oh, no. We try to minimize that as much as possible.
We do too. This is actually the one time I use paper most of the time. I have my computer up, but I realized there's sometimes when it's nice to have paper, sometimes when it's nice to write notes, but no files for us.
No file cabinet.
But we try to minimize that as much as possible as well.
Yeah, and to your point, right, like the trend right now is going more like online, digital, and that's what not just residents are expecting, but also like owners. Right. And that's also part of why there are a lot more out-of-state investors willing to just invest in a property you've never seen before because, they can check photos, it's easier to communicate with.
Well, there's companies like Roofstock.
Exactly.
Other investment companies where you can just bundle and group invest, which I'm sure there are some pros and cons to that. But there's more encouragement to invest that way nowadays, I feel like.
Yeah, there definitely is. There's no question about it. And that's what's made it easier for a lot of people, especially for people in markets like the Bay Area where you may have some money, but you can't, you're priced out of the Bay Area just because it's too expensive. Then you can look at markets like Sacramento, for example, or, Portland, Oregon, or, Spokane, Washington, or Ann Arbor, Michigan, right? Or you can go to Lafayette, Indiana, or places like that, San Antonio, Texas, Santa Fe, New Mexico. You can look at all those different markets.
Still desirable places.
Yeah, where
just
you've
not
got
with the big price tag.
Exactly, where it's affordable for a smaller investor to be able to get in. Oftentimes you find, much better yields in smaller markets like that because the cap rates are higher. Here, if you're buying into a bigger market like this, you're buying more for appreciation rather than yields. But in smaller markets like that, it's a combination of, yields and appreciation. You might not get the appreciation, but, you have higher yields. And so it's, more affordable for the smaller investor. But then, with, virtual reality out there, with the videos that you can do, you can get a really good view of what's going on with the property without actually having to be present. And then, if you hire a professional management company to manage it for you, and then they have the cloud-based, software, then you can go online, you have your own portal, you can check out pictures, you can get your financials, you can see what invoices have been paid, etc. So, what inspections have been done, all that kind of stuff, work orders that are open. So,
yeah.
It's interesting that you mentioned investing, like living in a more expensive area and investing elsewhere. I've been reading a lot recently about, millennials doing that, living in somewhere like New York or San Francisco or somewhere where the cost of living is high, the cost to purchase any type of property is really high, and people continuing to rent, or millennials continuing to rent but buying somewhere in like one of the places you mentioned.
Yeah, it's definitely a way for them to start building wealth, right? I mean, for my generation and people slightly younger than me, some of their greatest assets are probably tied up in the real estate that they have, is really what it comes down to. But with the younger generation, the Gen Zs and the millennials, because of the student debt and because of how difficult it is to get mortgages and stuff like that, how expensive rents have been, they haven't saved for the down payment for where they want to live, right? And so they can't afford to buy a home where they want to live, but yet that's where they want to be. It's more affordable for them to rent, so they stay there, but they look at opportunities to create wealth elsewhere. And so, they purchase properties as a good investment, in markets where they can afford it, where they've been able to save up. In some markets, you take Lafayette, Indiana, for example, right? It's close to Indianapolis. You have a growing, job base there. You're starting to see the logistics business spread out from Indianapolis. It's, major airport. They've got the sports teams there, right? But yet you can still find single-family homes for under $150,000. In some places they're even under $100,000.
It makes me
Why
jealous.
not invest? I know it makes me jealous, but it's also the reason I kind of almost brought it up again after you said that initially. It's just because it's a good idea. It's a really good idea, and I think that some people are taking advantage of it and some people aren't. I wonder if that's something that property managers should be leveraging as a form of communication to their tenants. Like maybe if they have partnerships with other real estate investors in other areas, they could reach out to their tenants like, hey, I know it's expensive to buy property here, but investing is still a good idea. If you have the money to buy, just not here, we have the resources to connect you with somebody here, somebody there.
And it's not even just between state lines here. So I remember during the last PM Grow Summit, we were talking to the owner of property management company in Canada. And, in so doing, he mentioned that they have a lot of clients who are investors who want to invest also in the US, not just in Canada. And they have this page on their website that just like lists out all the different property management companies they've found online who are in the States who
can recommend.
They can recommend. And they just have linked to the websites. And I asked them, why are you just like blindly sending off your investors to go contact these property managers? This is a trend. Like investors want to, expand their reach, make partnerships with these property management companies across, because they might have investors in their markets who want to invest in Canada. And then you're all the more knowledgeable when you have these partnerships, because you not only like share clients, you can share ideas and market information. So
it's like building the relationships. It's like building the relationships to have them, but also planting the seed with the type of people you want those relationships to benefit from. Because like as a renter, I'm always saving money. Like I want to buy a home, but I live in the San Francisco Bay Area, so it's gonna be a little while. And obviously, I've been recently doing research, looking how I can invest in other areas. But if my landlord or somebody like a local property management company or even just real estate company was reaching out to me, planting that seed, I think it would make it more likely for that to happen sooner. I don't know. That was just
that's actually really good ideas, because ultimately you never know where somebody's going to live, right? And more importantly is you don't know who's got what money and what their motivation is to do with that money, right? So I mean, you've got a lot of millionaires out there living all over the country, and they may live in Indianapolis, for example, right? And have decided that they want to try their luck in the Bay Area, right? So if you developed a relationship with a property management company in Indianapolis, they could recommend you as a potential partner to look out here, for example. So that's actually a really good idea. And then as far as, your tenant base goes, right, I mean, for the millennials and then the Gen Zs, it's all about relationships, right? That's really what it's all about. And so, if you're developing those kinds of relationships to where you can have that kind of communications with them, that's, going to endear them even more to you. You're likely to keep them longer as a tenant, right? Because they feel grateful that, you're really trying to help them out.
There's a trust that's built.
Very much, and that's, especially for Gen Zs, trust is a big part of what they're looking for.
Definitely.
It kind of goes back to what you were saying earlier in the very beginning, how even though you might not be able to help your current clients buy more properties in the area, you're doing it already. So I kind of just stole your idea that you said earlier.
You should trademark that.
I'm good at stealing ideas.
So so you had shared with us kind of like an overview of like what you've seen has changed since the time you started in the industry, and then now with the advent of technology and just people thinking of real estate and like their home a completely different way than it was like 10, 15 years ago.
Their needs changing.
Yeah, their needs changing. The American dream has changed, because before it was like, I want a house and a lot with a picket fence. Now it's like, I want to pursue my passion, and if that means moving across the globe, 3 times within the year because I need to know which one like speaks to my soul, for example, then that's what I'll do. And so just completely different. Are there like specific changes you've observed in each tier that you'd like our audience to maybe get a better idea on or want to point out?
As far as like, the primary market, secondary, tertiary, is that what you're referring to?
Yes.
There certainly has been a pretty significant change in how people approach that, right? I mean, what you're seeing in all markets, actually this kind of cuts across all the tiers, is that people want to live where they want to live, right, is really what it comes down to, regardless if it's, the Bay Area or if it's a smaller market like Austin or even a smaller market like Omaha, Nebraska, for example, right? They want to live where they want to live. And so, they don't have a problem with renting because that's where they want to be, right? So you have seen, that big change is really what it comes down to. So in the primary markets, I would say the biggest change that you've seen there is with the baby boomers, right? They're, giving up their homes. They're looking for the convenience of just renting and not having the hassle of home maintenance, but they also tend to be more affluent, and so you find them moving into the urban areas. They're tending to move into your bigger markets, primary markets, where they have access to the amenities that they want. For them, as I mentioned earlier, it's all about walkability, right? They want to be able to live someplace and then be able to walk. They don't necessarily want to have to get in a car to drive places. So so they're looking for the convenience of shopping, theater, healthcare, right? Restaurants, and but yet they still want to have easy access to major airports. So when they travel, they can get out easy in places like that, right?
Places with Ubers.
Yeah, places with Ubers and Lyft.
Yes.
So.
This is not sponsored, by the way.
Right. So the baby boomers, that's what they're looking for there. And then what you're starting to see, especially with the Gen X and then some, to the millennials, you're starting to see them, move into the smaller markets. So you're seeing them move to the tertiary markets, secondary markets. And for them, they're moving more into the, suburbans. They're looking, as I mentioned earlier, the single-family homes, right, where they have safe neighborhoods, family-friendly, but yet still convenient. They're still looking for the convenience of restaurants, shopping. They still want the convenience of an airport, those kinds of things. Yeah, good middle ground. And so, you're starting to see, that. But the big thing that I think you're seeing is you're seeing a real change in the economics in some of these areas where it's like, all of your businesses tended to congregate in your big metropolitan areas. You're starting to see a lot of businesses, move out of these big areas for a variety of different reasons, right? Blue Bottle, I think, just recently announced that they're moving to Sacramento, for example, right? Primarily because, rents in the area are pretty expensive, and so they can get, nicer places for less rent. Mm-hmm. But the big thing is both from a labor point of view and then a housing point of view, right? And as I spoke about before, the shortage of housing and the affordability of housing, makes it difficult for companies, to retain, good workers. And then you've got such demand for workers in areas like the Bay Area that it's hard to even acquire, good workers. And so, you can go to a place like Sacramento where you've got, good stable jobs, you've got, a nice educated workforce. And so, you don't have as much competition, to hire good workers. And so you're starting to see a lot of companies move into smaller markets, which has been helping in those smaller markets, from a rental point of view, right? So, you're seeing a lot of that happening. You're seeing, smaller markets. So it's like, Dallas, for example, and Austin. I mean, they've got their booming tech sector just like, the Silicon Valley is, and so, that's playing a big role in, people moving out of, the metropolitan areas such as the Bay Area or Boston or New York, for example, and moving to these smaller markets. So, you're seeing, that trend.
Yeah. Well, and even the smaller markets like Sacramento, for example, like you were saying, it's just even living there has become more desirable in the last, I would say, 10 years.
Yeah.
Just because since people are moving there, more businesses are being established.
Right, and they have a much more dynamic cultural scene going on. You're bringing in a lot more diversity, so you're getting a lot of different types of restaurants moving in. You get a lot of different types of shopping, available, but yet it's still considered family-friendly, safe place for people to be, right? And so that's
like
that's
the
what they're
best of
looking
both
for.
worlds.
Yeah, exactly.
Yeah.
Sacramento in particular, because they've got the whole riverfront down there now, which is that's very appealing for the younger generation. Absolutely.
For sure.
And so with all these changes happening, right, in the market, whether it's the primary, secondary, tertiary markets, how should a property manager keep pace with all these changes? Because it's one of these things where it's not like overnight, like one day, this is status quo, and then the next day it's completely different. It's easy to pinpoint the changes. It happens gradually, right? And so it's very easy to get sort of like stuck in sort of, oh, this is how it's always been. But then if you're not like keeping, your hand on the pulse, it's easy to start just, veering away from what's really happening. And so how would, a normal property manager ensure she is like noticing the little things that they should be taking note of?
Right, yeah. So, there's a multitude of ways that you could really address something like that, right? I mean, first and foremost, the key is to developing strong relationships with your owners as well as your tenants, right? Because, you really want to be cognizant of what their needs are, making sure that you're addressing their needs. And, a lot of times, things will be driven by what they're asking for, right? So if you're being conscientious about, your owner needs, your tenant needs, and you're making a concerted effort to try to address those, you'll kind of more or less keep your pulse on sort of the changes that are going on, because they oftentimes will be dictating that. But the other thing that I would recommend for, property managers to do is make sure that they stay up with, all the various trade regs that are out there. I mean, there's numerous publications that you can subscribe to, and numerous professional organizations like NARPM, IRM, are two big examples of professional organizations that you can become part of, and that they share, a wealth of information as far as what's going on, with the various partners that they've partnered with, right? So you've got those types of things. And then I would encourage people to go to various conferences, right? There's all sorts of real estate conferences, put on by a variety of different groups. Again, NARPM, IRM 4.5 has their growth summit. And so, there's plenty of conferences for people to attend to, that's a wealth of information as far as, what's going on in the marketplace. So those would be, sort of my three recommendations. The key being obviously is to develop those relationships with your owners and tenants. I think that's really the key as far as what drives, the marketplace.
Yeah, that's really interesting because in the property management industry, a lot of times, there can be tenants who ruin it for the rest of the tenant pool, right?
Yeah.
There, you have these
where you don't want to.
Yeah, you just get drained just dealing with a small handful of tenants that you want to just shy away from the tenants and say like, you know what, I have a team that can handle the tenants. I'll just deal with the owners.
They get type of thing.
But to your point, right? Like one of the best ways to consistently have a feel for what's happening in the market is to have those conversations, have those relationships, not just with owners, but your residents, because who's paying the rent? The residents. Without the rent, you can't really, succeed.
Well, and applicants too.
And
so
applicants.
It's like your current residents listening for what people are asking you when they're applying. Hey, like you were saying, do you have Wi-Fi? Do you have hubs? Do you have, free water? Whatever it is, like whatever like they're hoping is included. That's a good indicator. And then when tenants are up for renewal, do they also ask those same type of questions? Like, hey, I'm signing a new lease. Is there anything new? Like, do they do that? Because, I know that...
Sometimes they do, sometimes they don't. It just depends upon, the condition of the property at the time that they move in and what amenities that property already has, right? A lot of tenants, are looking for the in-unit washer and dryers, for example. A lot of tenants want to be able to have pets in their units. They want it to
Those
be
are
pet friendly.
things to listen for.
Right. And so, especially the younger generation, the Gen Zs, the millennials, they're looking for energy efficiency, right? So, they're looking for the smart appliances, they're looking for the Nest, for example, so that, they have the climate control. They're looking for those types of things. And so oftentimes, if they move into a place that doesn't have it and it's up for renewal, they'll sometimes ask about, well, can we get a Nest, or can we get this, or can we get, smart, a smart refrigerator, various things like that, all in a way to help, minimize, the environmental impact of certain things. So you do get some of those requests, right? But largely, if you're really meeting the tenant's needs and you're being responsive to them and you're, empathetic to what they are and you're listening to them and making a concerted effort to try to address their needs, most of the time they're pretty content and, will renew as long as, they don't have a job move or something like that, right?
Yeah, ultimately feeling secure and happy in the home is more important than having a fancy thermostat.
Exactly, because for them, even though they're renters, they consider it home, right?
Yeah.
They don't consider it just a transient place that I'm just going to hang my hat or put my boots for a while.
Mm-hmm.
They actually consider it home, right? And so, they want to feel safe and they want to feel heard. Is what they want to hear, right? They want the comfort, the convenience of things, right?
Absolutely.
That's what they want.
I had one more question. So, given the importance of understanding where the market is, where the market's going, key things to do, right, to keep up with these changes, how do you ensure that the rest of your team kind of like keeps up with this? Because obviously, as the owner of the company, it is incumbent on you, right, to make sure that you're aware of what's happening in the marketplace so you can pivot your team if need be. But do you also have your team subscribe to publications? Do you have meetings where you share these insights with them?
Oh yeah. I have in my office. I have monthly staff meetings, where we go over a lot of the changes, regulatory changes. For example, like recently with the homeowners association, they just signed Bill SB 232, I think, which has significant ramifications for how you manage homeowners associations, for example. So, what I'll do is I'll have one of my staff research that and then present their findings at a staff meeting.
Really great.
Is what we do. Or I require my staff to always have continuing education, for example, or I'll send my staff to a seminar or a conference, and then when they get back at the next staff meeting, I'll have them present everything that they heard and found at these conferences and staff meetings. So that's my way of keeping my staff informed, educated, so they're up to speed and date on all the various changes that are happening in the marketplace, both from just sort of a trend as well as regulatory point of view.
So it's not just your responsibility, it's their responsibility
To be
Absolutely.
accountable for too.
Yeah, it gets them engaged, right? It gets them engaged and, makes them feel like they're more part of a team and that they've got this specific knowledge that they can share, so, I find that my staff really enjoy doing that.
Yeah, it's also very empowering because instead of all the knowledge coming from top to bottom, over time you start building subject matter experts within your company. Hey, he's the person to go to whenever it's, let's say, HOA specific stuff. That's the guy to go to. And then you yourself start feeling yes, I am the HOA expert, right?
And it also creates, I feel like, with new team members or people that may be intimidated by getting information from the owner all of the time, it might create more openness to ask questions.
It does. Yeah, and then you find that when they're together, they tend to talk amongst themselves a lot more and start sharing a lot more information. Because you'll have somebody that may go to like a legal seminar that's like tenant evictions and comfort animals and so on and so forth, and so they go there and then they come back and then they'll talk to the HOA person about the various changes that have happened with the HOA regulation. So there's just a lot more sharing of information. When you have people that have more specific knowledge about this or that. So
that's amazing.
Yeah, very good. I think that for me, the main takeaway that I got from this entire conversation was just that everything's changing all the time.
It's constant.
And you don't know. You have to keep educating yourself.
Right, and you have to be aware of what's happening in your specific marketplace. Like if you're a smaller management company and you primarily just manage units within a very defined geographic region, you have to be aware of what's happening in that region. If you're primarily like in the city, you might be finding that most of your tenant applications are now your older baby boomers, right? And so they have certain expectations for what they want in housing, and so you need to make sure that you're meeting their needs is really what it is. But if you're more in a suburban area, you might be finding that you're getting a lot more of the millennials and Gen Xers, and so their expectations are going to be a little bit different for what they're looking for. So as a management company, I think it's really important that you understand who your marketplace is, who you're catering to, and that you're addressing their needs is really what it comes down to. So you want to be empathy driven, technology enabled.
I like that.
Yeah.
Jinx, almost jinx.
But I love that final thought, right?
Yeah. Very strong and powerful.
Yeah. So to our listeners, for this episode, we hope that you had a lot of insights to learn from what Jeff has generously shared with us, and also have a better idea of how to keep not just yourself informed of what's happening in your marketplace, but also your team engaged and informed. Because I think they always say, right, you're only as strong as your weakest link. And if the culture within your company feels like everything's top to bottom, if somebody who is new notices something, they might not speak up because they're like, oh, I don't know anything about this. But if your culture,
that's where you want the ideas coming from.
Exactly. If you have this culture that celebrates, hey, everyone has their own kind of realm, and even the owner might come to the HOA expert just to bounce ideas off of, then the smaller guys are more likely to share their ideas and just make the company better.
And you're more likely to be up to date with all the trends.
Exactly.
Yeah. Well, thank you so much, Jeff.
It was my pleasure. Thank you for having me here.
This was really wonderful. Yeah, we enjoyed talking to you so much. Learned a lot. Great conversation. Yeah. To all of our listeners at home, in the car, wherever you may be. Jogging, you might be jogging. You might be eating ice cream.
Biking.
Who knows? Biking, yeah. Please let us know if you have any questions. Hopefully you enjoyed this. If you have any questions for Jeff, let us know. And hopefully you liked it.
Thank you very much.